My name is Daniel Couch, and I'm doing my presentation on running the numbers on an EHR, applying cost-benefit analysis in EHR adoption. The goal of this article is to demonstrate how organizations can apply financial methods to determine if an EHR investment is worthwhile. The goal of this presentation is to explain the following. The first objective is to identify the steps of cost-benefit analysis. The second objective is to estimate the costs involved with EHR adoption and describe the project's inflows and outflows. The third objective is to show how to discount costs and benefits at an appropriate rate. And finally, we want to complete an analysis by calculating net present value. Implementing a new EHR is a pricey endeavor, and even with meaningful use dollars available to offset the expenses, it requires organizations to invest large amounts of money during implementation. For this reason, it is essential for health systems to have a good understanding of the return on investment. To do this, organizations should perform a cost-benefit analysis to carefully measure the gains and losses generated from an investment to determine if the initiative will become profitable. When performing a cost-benefit analysis, organizations will follow these steps. Number 1, determine project goals. Number 2, estimate project costs and benefits in dollars. Number 3, discount the costs and benefits at an appropriate rate. And number 4, complete the analysis by calculating net present value. An EHR adoption generates many cash flows over its life. A project outflow is identified as the total cost of the project and comes in two different forms. System costs, which include hardware, software, implementation, training, and support, and induced costs, which include loss of productivity that is likely to occur as staff adjust to the new system. Money-saving benefits on an EHR adoption are identified as cash inflows. Examples of cash inflows include the following: payer-independent benefits, which come in the form of money saved by the elimination of chart pulls and transcription; benefits under capital reimbursement, which includes reduction of adverse drug events and duplicate diagnostic testing; and fee-for-service benefits that include the advantages gained through improved billing. In this example, Anywhere Hospital has just concluded year 1 of their EHR adoption, and they would like to calculate their annual cash flow. As you can see, they saved a total of $2,500 from chart pulls and an additional $2,000 in transportation costs, bringing their total cash inflow to $4,500. To calculate their cash outflow, we will add up all the incurred and induced costs. Over the past year, Anywhere Hospital has spent $7,000 with their EHR adoption, bringing their annual cash flow to negative $2,500. That brings us to net present value. Net present value is the difference between present value of cash inflows and the present value of cash outflows over a period of time. Health organizations often use net present value to analyze profitability before investing in an EHR. Due to the hefty initial costs of adopting an EHR, it will likely be several years before an organization can begin to see a positive return on investment. However, these initial costs should not automatically deter an organization from investing in a new electronic health record. To determine whether or not to go forward with the investment, health systems should calculate net present value of the project. If the net present value of the project is positive, the health system should adopt the EHR. However, if the net present value is negative, the project should be declined. To calculate net present value, you first must have an understanding of present value and future value. Present value is defined as the current value of future cash flows discounted at an appropriate discount rate. Future value is defined as the amount an investment is worth after one or more periods. Performing a cost-benefit analysis involves calculating the present value of future cash flows, which takes into account the present value's interest rate, also called the discount rate. Now let's turn our attention back to Anywhere Hospital, who is completing a cost-benefit analysis for a period of 5 years to determine whether or not to go forward with their EHR project. If you recall, Anywhere Hospital is anticipating a negative cash flow of $2,500 for year 1. However, we are not interested in $2,500 a year from now. We are interested in the present value of $2,500, or how much that cash flow is worth today. After going through the present value calculations, taking into account a discount rate of 10%, we find the present value of $2,500 is $2,273. We then move forward and find the present value of the cash flows for years 2, year 3, year 4, and 5, and the sum of all the present values will give us the net present value for this project. As you see, Anywhere Hospital has incurred a loss during the implementation of their EHR, but we're able to make up for the negative cash flows in years 2 through 5. The total present values gives us a net present value of $49,276, so we can determine that this is a worthwhile investment for the hospital. Although this article was written in 2010 and most organizations have since adopted an EHR, I think it's essential reading for organizations that may have outgrown their current EHR and are looking for an upgrade. At my organization, we are switching over to a new EMR, and this article was very insightful on some of the thinking that occurred behind the scenes. Thank you for viewing my presentation on running the numbers on an EHR adoption. I look forward to your questions and comments. Thank you.